Treasury bonds can offer you a secure alternative place to invest your funds while getting very good and consistent returns. I will summarize this to you in a simple way, particularly to help you understand treasury bonds, the options available, how to invest in them, and the step-by-step guide that you need to take to invest in the treasury bonds. Please join the quickly growing community of MoneyVersations, which is creating an easy environment, not an intimidating one, to help you learn more about personal finance, investments, and business altogether. To join us, all you need to do is to press that subscribe button, and don't forget to like this particular video. Let's get started. Treasury bonds are secure mid-term to long-term investments which are offered by the government. In short, it is a way through which the government borrows money to fund its own expenses. These treasury bonds are usually auctioned by the Central Bank of Kenya on a monthly basis. They do offer a variety of bonds all through the year long. Therefore, whenever you wish to invest in treasury bonds, you should check which options are upcoming at any given time, and this is found in their website, which I will leave a link on the description below. Most of the treasury bonds sold in Kenya are called fixed rate bonds, which means that the interest remains the same or fixed for the entire life of the bond. And because of this, many people have considered the bonds to be a credible long-term source of income, which again is predictable. So from time to time, the National Treasury also issues the infrastructure bonds, which are slightly different from these normal treasury bonds in that they do offer a very attractive return on the investment that you put in, and they are tax exempt. I have done a complete tutorial of the infrastructure bond investments, and you can check it out in the description below. You can invest in treasury bonds either as an individual or as a corporate body. So what you need to note about the treasury bonds is that, one, they are auctioned every month. Therefore, they constantly provide you with an investment opportunity. Second, they are very flexible. And this is because the central bank auctions different or several types of treasury bonds. You cannot lack something that will specifically fit your needs as an investor. And next, they are secure. Treasury bonds basically mean that you are investing in the government. Finally, they give regular returns. The treasury bonds carry out a semi-annual interest payment plan, which ensures that every investor will receive payments of interest on their money or returns every 6 months. So, what are the steps that you need to take if you wish to invest in treasury bonds? The first thing you need to do is to open a CDS account. A CDS account is what will help you to invest in both these treasury bills or treasury bonds, and it is free to open. The CDS account only needs to be opened once, and then you can use it thereafter for several other treasury bills or treasury bonds for life. In order to open a CDS account, you must first hold an active bank account with one of the local commercial banks. Then you will need to collect a mandate card from the central bank or its branches, clearly indicating your information and your bank details. And there has to be 2 signatories from your bank who will have to sign the mandate card to verify the information that you have provided. So when returning the mandate card, you will also be required to submit a clear copy of your national identity card or your passport, and also submit a passport-sized photograph of yourself, of course, which has to be certified and stamped by a representative from your local bank. The second thing you need to do in order to invest in treasury bonds is to decide how you wish to invest or how you want to invest. The treasury bonds are usually offered for a set amount of years, usually between 1 to 30 years. Therefore, when choosing a bond that you will invest in, you need to consider what is available in the auction that is upcoming at that particular time that you want to invest, and also consider how long you wish to commit your funds for. As I mentioned earlier, there are several types of bonds that you can choose from. Most bonds auctioned by the central bank are fixed coupon rate treasury bonds, which means that the interest rate will not change until maturity. Number two, there are infrastructure bonds which usually have a very good return or interest rate and are also tax exempt. And number three, there are also zero coupon bonds, which are similar to treasury bills in a way, in that they are usually sold at a discount and do not have an interest payment. They are basically short-term bonds, and before I get you lost, when I say they are sold at a discount, it means that if the rate is 10%, for example, and you wish to invest 1 million, at the point where you are investing, you will only submit 900,000. You will keep the 10%, but then the full 1 million will be collected at the end of the term. So for this, you can also check the other video where I've explained how treasury bills do work. I will leave a link on the description below. Once you've figured out what you want to invest, the next thing to do is to monitor their upcoming bond prospectus. In the prospectus, you will find information about the different bonds that are available or that are on offer, and this includes the bond's duration and the coupon rate. If you're wondering what I mean by the coupon rate, this refers to the interest payments that you will be receiving each 6 months. They can either be determined in the prospectus, which is usually typical for the longer period bonds, or can also be market determined. The prospectus will also include information about when the investors will be receiving their interest payments and the final redemption payments, as well as how much tax you are going to be paying for the interest that you will be receiving. Sometimes you could also find the information on amortization, which is simply a timeline that the government sets whereby they feel like they would have realized significant returns and therefore will have made available a way for you to take back part of your money or all of your money, but depending on limits that have been set. And this happens before the maturity arrives. This, however, will come with limits, as I've mentioned, to which you can be able to enjoy or access that. Amortization helps the government to reduce the burden that comes when the bond matures all at once. That's why they make a way possible to start paying it way before the maturity dates or the end of the term. The next thing to do is to complete and submit an application form. This includes information on the treasury bond you want to purchase, like the issue number, the duration that it will take, the face amount, and the value you want to invest. It also includes information about yourself, which includes your name, telephone number, CDS account number, your bank account number, and whether the funds that you're investing are coming from a local or an offshore account. On the application form, you have the option of selecting a rate or the interest rate that you will receive every 6 months. If the bond has a predetermined coupon rate in the prospectus, you should choose the non-competitive or average rate. If the prospectus says that the coupon rate is market determined, then you can select either the interest or competitive rate, or the second option, which is the non-competitive or average rate. Those investors who choose the interest or competitive rate bid on the bonds by submitting the coupon rate they would wish to receive or invest for, the central bank then decides what bids it will accept, and usually it uses the average of the rates that the investors did. And therefore, everyone who chose the non-competitive or the average rate will get to go with the rate at which they will decide upon. The next step when buying the treasury bonds is getting the auction results, which are usually communicated through the Treasury Mobile Direct or the TMD, the Twitter accounts, or in the CBK website on the statistics section. Once the results have been announced, you will need to call or visit the central bank in person to check whether your application was successful and to determine how much you're supposed to pay or deposit for the bond. And the payments, remember, are supposed to be made latest by 2 p.m. the following Monday if you were successful. Lastly, the payments can be submitted in cash or banker's check if the payment is below 1 million, that is. But if more, through a transfer. It's good to note at this point that the minimum you can invest in bonds is 50K, making it accessible to many investors. But those who are successful applicants but fail to submit payment within the time allowed are likely to be barred from future investments. At maturity, you will have an option to either roll over if you wish to once the bond matures, but upon maturity, the investors will receive the face value and the interest due for those last 6 months. For any feedback or question, please leave it in the comment section below, and I hope that you have learned something in order to invest successfully. Please subscribe and see you in the next video.